Larry, I still think the chart of the 10-year yield is one of the most interesting, consistent, and probably important ones out there. So what do we learn about bonds this week?
Wow, that's confusing. I mean, consider the fact that when we were talking this time last week, yields were exactly where they are today, like 109, 110, and really what a 24 hours it's been. You'd think that there'd be some type of flight to quality starting with the Chinese market when China raised their overnight rate, 5 3/4 high of 3 7/16. Really unbelievable. That put the stock market on its back, but it didn't do a whole lot to yields. I think what happened was really in a European session where we saw German bonds jump 4 basis points to -50 at one point. A lot of that was just headline trashing with regards to the ECB not going to be cutting rates anytime soon, combined with good information coming from Germany. So here we are today. Even though the stocks are down, yields are up as we speak.
Larry, that part is important. Back in October and September, I did the math on the degree to which bond yields firmed and dropped as the market sold off. And for a 10% decline that we had in the stock market from September 1st to 3rd, the move in bond yields was very small compared to what normally happens with the 10% sell-off. I'm curious what you think that relationship is going to be if, let's say, we do have another risk-off event in stocks. Is it possible that bonds will increasingly be less, or I should say, to phrase it more simply, will be an even worse hedge than they were last time?
Yeah, every time is different, as we know, and history rhymes. It doesn't necessarily correlate. That said, if the risk-off move is something new, something that hasn't already been baked into the market, then you'll see Treasury yields most likely act as the hedge as they typically are, or at least what they're typically sold to for being, that bonds will go up, yields go down. That said, there's been so many triggers in the market that have been mitigated by fiscal and political, all been mitigated by reality. And so right now we're just seeing a breakdown in that correlation. I don't think it'll last forever, but I do think, reflationary ambitions are still there. When you look at 10-year break-evens at 211 this morning, despite whatever FOMC says, there are reflationary ambitions, and the stock market is kind of following its own track right now.
Larry, I see in your notes that you retain the bias for lower rates, but the momentum in terms of trading, that seems a little bit of a different message from when you've been trading the yield curve expansion with us. Have you changed your view? Are you feeling more bullish about bonds at this point, or are you just saying that it's going to be hard to really lift off?
Yeah, no, you're right. I mean, it looks like today's move is big, considering what the equity market has done. But keep in mind, we're unchanged week over week. It really hasn't moved really at all. I'm just thinking that with the severe amount of bearish impulses that were, or triggers that were in the market over the last 2 to 3 weeks, and we only got yields up to 119 and barely at 119. I think the next place is down a little bit. I think there's so much. I don't think long term we're going to be down, and I think 95 basis points makes sense to me on a low yield point. But I think that, we weren't able to outdo this, and I don't think there's anything that can happen right now to outdo this, except for some overwhelmingly positive pandemic progression.
Now, that overwhelmingly positive information from the pandemic paired with economic data, it seems right now today you could kind of take both sides of it. If you look at the stock market, maybe there was some negative read pointed that I made at the top of the show. I don't really buy into that, Larry. It looks like if you look at the way the market has responded in the past to vaccines, it actually kind of looks like this. When we got the big vaccine news, the NASDAQ got slammed the original announcement. The dollar firmed. Bonds were down. It seems like we've got some good news in here if you look at those assets.
Yeah, and you look at our numbers today. I mean, I know they're second tier, but personal income, personal spending, deflator rose, everything. That's all fueling that whole reflationary story that's underneath the market. And I think the stock market, with all the volatility that we've seen with regards to everybody's an expert now on borrowing stock and options and stuff like that, I think that's just been following a different track, and the price action is actually more the headline than anything else. It's not following economics right now. With regards to yields, I mean, it's really based on nothing other than the progression of the pandemic, and we're going to have something really overwhelming. Otherwise, I think yields will back off a little bit in short term, 90 to 95. But my year-end target still is around 120, 130.
Okay. All right. So you're still looking for the yield to continue climbing towards the year end. Larry, what will make you push that target for the yield higher? Is it if we manage to get back above from where we were in the beginning of the month? I mean, we got to 1.18, and to your point there, the bias towards the low yield regime did show up again. But now we've got personal incomes that this morning looked pretty solid, and it looks like we just keep bouncing every time on this diagonal trend line for yield.
Yeah, and when you see like German yields, which, they're yielding negative 50, to jump 4 basis points based on headline, I mean, we're correlated to their yields. And so with that in mind, we got some of the push from that today up to 110. Will it last? I mean, I don't know. I mean, I really think there's going to have to be some overwhelming new evidence with regard to the pandemic. Otherwise, I just think that the path of least resistance on the short term is lower rates. I mean, I still believe 125, 130, and to get beyond that would have to be, GDP growth of proportions that we've never seen, like post-war type GDP growth for that to happen. I think there's just too much money in the system. We're not multiplying it as fast, and getting beyond 125 would be tough business.